Hello everyone, welcome back to the Passive Money Mac channel. My name is Mac, and in this episode I'll show you a couple of ways on how to beat inflation in this bearish market that we're dealing today. Without further ado, let's get right into it. So we all know what's going on with the market these days. If you have no idea, make sure to check out my other video in the description below to get yourself up to speed. Anyways, with the market the way it is now, if you're invested whether on the stocks or crypto, you're most likely losing money. It's been months that the prices of everything seems to be rolling in a downhill. So here are the ways to ease up the losses and maybe still find a way to get a profit in a bear market. First, invest in the broad market index funds or ETF, for example, the Standard & Poor's 500 or S&P 500 for short. This is an index that tracks 500 of the largest US companies based on their market capitalization. This is great for beginners because it can help your portfolio gain broad exposure to the essential stocks in the market. More examples would be ticker symbol VTI or Vanguard Total Stocks Market Index Funds that has a price range of around 200 plus today. This index fund is made of these equities, which is led by consumers discretionary with 15% as of 2022. With Apple being the first one of the month and 10 largest holdings as of March 31st, these 10 largest holdings is equal to 25% of total net assets of this ETF. Hypothetically, if you invested in this ETF back in 2012 with $10,000, your 10-year growth would amount to $34,679 as of 2022. In addition, if you own this ETF, you will also be gaining passive income through dividends. Keeping your money in the bank like a savings account is not a good idea because you're earning little to nothing in terms of interest. Plus, with the inflation, the value of your cash will be less. And if stocks are not your thing, then the second one is going to be the treasury bonds from the government, more specifically the Series I savings bond. If you're hearing this for the first time, let me give you a quick detail about it. A Series I bond is a non-marketable interest-bearing US government savings bond that earns a combined fixed rate and variable inflation rate which gets adjusted every 6 months. I bonds are meant to give investors a return plus protection on their purchasing power, meaning the higher the inflation percent of the economy, the higher the return you can get. And since the inflation rate right now is at 8.5%, the government just updated their variable inflation rate this May, and it is at a whopping 9.62%. So for example, if you have $10,000 on your bank account that you're not going to be using anytime soon, you can purchase I-bonds from the government, and with the return rate of 9.62% for the first 6 months, you're guaranteed to get almost 10% of your $10,000. However, since this rate is relying on the inflation of the economy, after 6 months, the government will reevaluate this and will come up with a new percentage. The only catch for this is that once you've purchased the I-bonds, it will be locked and you won't be able to get it for at least a year, no matter what happens. So make sure that the money you're putting here will not be needed anytime soon. If for some reason you need to take your money back after and in between 1 to 5 years, there will be a 3-month interest penalty, meaning that if you have your I-bond saved up for 15 months, you will only get 12 months worth of interest. But if you leave your money in for 5 years, there will be no penalty. Moreover, there's a maximum purchase of only $10,000, but if you have a tax return, you can buy an additional $5,000 worth of I-bonds per calendar year, and the minimum purchase is $25 if you want to invest less than the maximum amount. I believe that this is a great way to fight inflation, so my money moves for this is that I've already purchased $10,000 worth of I-bonds, and since I bought it on April, the inflation interest rate at that time is at 7.12%, meaning that the rate will change on October and the 9.62% rate will kick in after until April of next year. If you combine these two together, I will get an average rate of 8.37% if I cash out after 12 months. Even after 12 months, I will still need to reevaluate the inflation after next year to see if it will slow down or if it will still be at a high rate. And with that said, thanks for watching, and if you learned something new in this video, smash the like button, subscribe, and comment down below on how are you surviving the dark days of the market. Again, this is not financial advice. Happy investing and good luck.